Welcome back to Forex tutorials. Welcome back to Forex tutorials. First and foremost, what is volume in Forex trading? It's the number of lots traded in a currency pair or the entire market within a specific time period. As a matter of simplicity, it's the amount of currency that exchanges hands from buyers and sellers, or between buyers and sellers, or bulls and bears. We shall look at using volume analysis in trading, demand and supply smart concepts. In this tutorial, you will see for yourself how wonderful and important volume analysis can be in the life of a trader. The extra edge it brings, a forerunner of divergence, harmony, and exposes strength, weaknesses, and confirms strengths for potential opportunities. Let's get started with how to interpret volume. Welcome back to Forex tutorials. From day one, we have a long bullish candle, which shows that buyers were more interested in the market than the sellers, since the candle closed completely bullish for that day, compared to day 2, which closed with a bearish candle, which clearly indicates that day 1 had more volume than day 2 based on the size of the candlestick volume. We can observe directly from the size difference with the bullish candle of day 1 compared with the narrow candlestick size of day 2 to show that day 1 had more volume in terms of buyers compared to day 2 that had a smaller volume, a bearish move. Now we have to understand how to read the volume bars on our charts. Let's start with the bullish character. Each time there is an increase in prices, for instance in the bullish direction, watch if as prices increase, or the increase in size of the bullish candle is directly proportional to the increase in size of the volume bar related to that particular bullish candle. Watch the candlestick, the volume bar under the candlestick. If the volume is also increasing with the increase in the price of the bullish candle. Also note that in this market, price increase with high volume and decrease with low volume. During price when price falls with a low volume, or price moves down with a low volume, it shows that there is weakness in the bearish direction. The bears are weak. That means the market is still bullish. Now let's look at the case of a bearish market. That's the bearish character. In a bearish market, when price is decreasing or falling and the volume is also increasing, it means that the bearish trend is likely to continue. In a bearish market, if price increases with low volume, that means the bullish move is just a retracement. The trend is still likely to continue in the bearish direction. Summarily, in a downtrend, if a bullish candle appears and the corresponding volume on that bullish candle is decreasing instead of increasing, it means that that bullish move is just a retracement and the market is still bearish and is likely to be a continuation of the bearish trend. Let's take a look of the market swing in the upward trend. That's swing A. Here the first 3 candles are bullish, moving in the upward swing. But when we observe their corresponding volume bars below, we can see that the third candle, the volume of the third candle was rather decreasing while the price was increasing, which means that the bullish trend was falling. The bulls were weakening. The first two candles had increased or had high volumes, but the final candle, the third candle, had a reduced volume, which shows that bulls were weakening. That means the increase in price was not directly proportional to the increase in volume. Hence, the bullish force was weakening. That's why market started falling immediately after the third candle. That's swing B. During swing B, we observed an increase in volume as price was falling, which shows that there is a likely continuation of the bearish trend. The movement of those candles will continue going downward. Now let's look at a case where price moves in harmony with volume with respect to an uptrend. What do we mean by price moving in harmony during a trend? Price volume harmony means when prices are increasing, the volume too is increasing. When prices are falling, the volume too is increasing. That means price and volume move in harmony. An increase in bullish strength should mean an increase in the volume, which shows that there are many lots being traded in that given time. So, as prices were increasing for the first three bullish candles, as prices were moving up, their corresponding volume bars too were also increasing, which shows that there were more lots being traded in the bullish direction, more buyers in the market. That's why the market continued to move up. But when the market started retracing, that's when the bears started pushing the market downward. We saw that instead of the volumes, the corresponding volume bars to be increasing in size, but rather they were rather dropping, which shows that the move was just a retracement. The bears didn't have enough power to continue that trend. Price harmony signifies a continuation in the trend. In summary, if price is increasing and volume is also increasing, then the trend is likely to continue upward. If price is falling and the volume is also increasing, then the trend is likely to continue downward. That's a harmony. That's volume price harmony. But in the case of divergence, if price is increasing and volume is reducing, it means the uptrend is likely to weaken or not continue. And for a downtrend, if price is falling and the volume is reducing, take note that when a market is going in a downtrend and instead of the volume to increase, the corresponding volume bars are reducing, it means that the market is likely to not continue in the downward direction. That is divergence. That is the increase in movement is not reflected by an increase in volume. That's the effort and results are not proportional. 2. Let's look at divergence. Market divergence. Here, the change in volume is inversely proportional to the change in market range, or an opposite movement between volume and market prices. So, at every point in time, we have to know who are in control of the volume. Is it the buyers or the sellers? This information is very important in order to decide which side we stand on, bulls or bears. There are two ways to read volume in relation to price and market direction. 1. Volume harmony. Here, the change in volume is directly proportional to the change in market range, or the price is in harmony. Remember, a range is a measure of how far a candlestick moves within a given period. A long candle means a long range. A short candle means a short range. Here are the general rules for interpreting volume to determine the health of a trend. Volume harmony with price and proportionality. 1. If price is rising and volume is rising, it means the market is strongly bullish. 2. Volume helps us to determine the health of a trend. An uptrend is strong and healthy if volume increases as price follows with the trend and decreases during retracement or pullback periods. Let's get into the details of divergence in volume analysis. If price is rising but volume is falling, it means the market is weakly bullish, indicating the uptrend is weakening. Whenever prices are rising but volume is decreasing, it tells a trend is unlikely to continue. Price may usually attempt to continue in same direction at a lesser pace, and once sellers take control, which is usually signified by an increase in volume on a bearish candle, hence prices fall. Here are the steps to begin with. After doing your multiple time frame analysis, define the nearest supply and demand zone. Wait for the price to come to the zone and observe the candle associated with the volume of the zone. See if there are signs of reversal or continuation based on the volume and price action. In summary, if price is falling and volume is rising, the market is strongly bearish. 2. If price is falling and volume is dropping, the market is weakly bearish, hence downtrend weakening. Swings of different sizes. This is important to study differences in the upward and downward swings. Market swings provides a clear insight information about demand and supply changes. By learning to judge the difference in sizes for both upswings and downswings, you will gradually learn how to spot when a rally or a drop is about to stop and reverse or turning points. We do this by comparing the volume of the current impulse swing with the previous impulse swing. But first, we have to make or compare if the volume of the current price swing is in same direction with the volume of the previous price swing. Is there divergence or harmony? That's it for the first part of this tutorial. Like and subscribe. Bye bye. See you on the next.